I think we're seeing a very important shift in the investment environment. For the past 30 years, we've lived in a deflationary environment, which was a direct consequence of globalization. And today, we're seeing a rise in inflation, which for me is part of the end of globalization and the start of deglobalization. And that was already the theme of my previous book, Clash of Empires. And it's the theme of this new book, Avoiding the Punch. So that's really the link. It's how are you going to build an efficient portfolio in inflationary times? Because bonds can no longer do the job that they've done for you for the past 30 years. Bonds are now useless in a portfolio. So how do you build an efficient portfolio when the building block on which so much rested is now basically become useless?
Well, hello guys, welcome with another video of Markets Are Everywhere. I'm very glad to have Louis-Vincent back again, because last year we recorded a video on the Clash of Empires, which is till now the best seen video on my channel.
Really? Oh wow!
And yeah, it's been praised from a lot of angles and also by a lot of professionals. For the people who don't know, Louis, can you give a very brief introduction of yourself and what you do?
Well, thank you very much. So apart from being apparently a big YouTube sensation that I didn't know about, in my daytime, I run a company called GAVCAL. GAVCAL is a Hong Kong and Beijing-based research and money management firm. And we manage money mostly in Asia, in Asian equities and Asian fixed income. We actually recently launched an Asian fixed income ETF. Ticker is AGOV, AGOV, and on the New York Stock Exchange. Yeah, so that's roughly who I am. I've spent really the past, I studied Chinese at university in the early 90s before it became fashionable, and I've dedicated a lot of my life to trying to understand, and I'm just saying trying to understand what's happening in China and what's happening in Asia. It's been a fascinating time, of course, to do it because, China has evolved so much in the past 30 years, and it remains fascinating. It changes all the time.
Yeah, and that is exactly for me the reason why I'm so glad to have you here, because in Dutch or in Western Europe, investment research, I think China is always, it's never considered in full. There's obviously some people who follow it, but no one as good as GAVCAL does it. So, let's get straight to it. And before you start your presentation, I have one question. If we look back to, let's say, the presentation or your book, The Clash of Empires, the last 12 months, where have we moved from the last video? What happened and what brings us here today, if you look 12 months back?
Yeah, Doc, I think the big change in the past 12 months, the main thesis of my book, Clash of Empires, that we discussed when we did our video last, the main thesis of that book was, look, the US and China are obviously pulling apart, and this will have massive global implications, not least of which on inflation. Because globalization was such a deflationary force for the world, and the impact of China was so deflationary for the world that basically, as China starts to pull away from the Western world, my thesis was, back in this book that I wrote two and a half years ago now, was that inflation would accelerate. So what has changed, I think, in the past 12 months is inflation has accelerated. It's no longer a theory. It's now a reality on the ground. It's a reality on the ground in the US. It's a reality on the ground across Europe. And for all the talk about how this is transitory, I tend to believe that it's not. Partly because, I think that the guys who think this is transitory put the blame of inflation on COVID. And so the view is, as COVID fades in the rearview mirror, so will inflation. Well, first of all, that assumes that COVID fades in the rearview mirror. So that's one assumption, number one. But number two, I think the assumption that all the inflation we have is because of COVID is a sort of, well, we had COVID and we had inflation, therefore they must be linked. But it's a bit of a, for me, it's a bit of a non sequitur. For me, the rise in inflation, what I'm going to try to show, and in fact, I see over your left shoulder, you have my new book,
Yeah, yeah.
called,
Let's.
yes, called avoiding the punch. I've got a copy here as well. So this one just came out 2 weeks ago. And
Yeah.
avoiding the punch is basically the thesis is, look, the inflation punch is here, and this has big portfolio implications. It's going to have big implications for currency markets, obviously for fixed income markets, for all asset classes. And the reality is most portfolios are probably not adjusted correctly for an inflationary world. And so the book Avoiding the Punch is, how do you adjust? It's really about how do you adjust your portfolio in this new era of inflation, an era of inflation which is driven first and foremost for me by deglobalization.
Yeah. So for people who want to order the book, there is a link below this video where you can easily get to the GAVCO website and you can order it. But first of all, let us watch this video and take us through your investing in the age of shortages presentation, please.
Absolutely. Well, look, you know the old story, right? If you have a hammer, everything looks like a nail. And for me, who spends a lot of my days looking at China, a lot of what's happening in the world finds its source in China. Now, again, the big question I think we all have to confront is this question of inflation. Oh, somehow my slides aren't working. There we go. Sorry. So, I think that, look, the first question we should ask ourselves is inflation transitory or not? And again, as I mentioned earlier, the transitory argument is, look, inflation's linked to COVID supply chain disruptions, and this will soon be over. I have a few problems with that argument. The first is that the idea that supply chain disruptions are going to be over, to me, is somewhat fanciful, given the fact that really we've seen zero capital spending over the past 18 months. Who in the past 18 months has gone out and built a new factory or drilled a new oil well? Or
Elon Musk has.
No, he's built a new factory in China. You're right, but it's few and far between. Very few people have gone out and hired a new workforce, trained a new workforce. So the idea that somehow magically we can switch things on and things will start appearing out of nowhere, when we have made zero infrastructure capital spending in 18 months, to me is fanciful. The second problem for me with that theory is the idea that we're all coming back on stream together, which is clearly not true. Sure, Europe is coming back on stream. Sure, the US is back online, but China isn't. And China is still essential in most supply chains today. And so, China is still very much on a zero COVID policy, where, if all of a sudden you have one COVID case in Ningbo, in the port of Ningbo, they shut down the port for 3 weeks. So, in such a world, supply chain disruptions aren't about to just magically disappear. Now, when you look at China's zero COVID policies, I think when we look at it from the Western world, we think this is crazy, right? It's like, it makes no sense. It's time to get on with it, learn to live with COVID. From China's own perspective, the zero COVID policies have made a lot of sense. The propaganda from the Politburo is, look, they've had all these deaths in the Western world. You're so lucky to live in China, where we take care of our own, and we've had no deaths, et cetera, in China. So that's number one. Number two, I think we have to acknowledge that there's two key dates coming up in China. The first is the Beijing Winter Olympics, starting in February. It's highly unlikely that China reopens before then. In fact, it's almost impossible. China isn't going to reopen before the Winter Olympics. The last thing they'll want is overflowing hospitals at the same time as they're hosting the Olympics. It would just make for a very bad look. The second important date after the Olympics is the October-November Congress, where Xi Jinping, October-November 2022, so 12 months from now, where Xi Jinping is supposed to get his third term. So if you're Xi Jinping and you're thinking, okay, in the run-up to Congress, do I reopen? If I reopen, I risk the disease running rampant, especially given that the Chinese vaccine that everybody's had, the Sinovac, doesn't seem to be working very well, at least relative to Western vaccines. So it would be quite a loss of face for me if all of a sudden the disease started to spread, while in the Western world, it was getting better. So the odds that China reopens massively between now, I think, and the summer is pretty small. So I'm just highlighting this, because a lot of the supply chain disruptions we are living through today do find their source in China. But beyond that, beyond the COVID-related stuff, I think a lot of the supply chain disruptions, most notably in semiconductors and in energy, which are the two really key inputs into our economic system. Most economic activity is really, transformed energy of one kind or another. But the two key shortages today, semiconductors and energy, I don't think find their source in COVID. They find their source in something else. And I would say they find their source in the belief amongst the Chinese leadership that the US is out to get them. So let me explain. I'm going to ask you, Jean-Paul, to put yourself in Xi Jinping's shoes for just 1 minute. And I'm going to ask you a question. I'm going to say, okay, if you're Xi Jinping, what was the most traumatic event of the past 5 years? And the answer is not COVID, and it's not Evergrande or Huawei or anything like that. The most traumatic event of the past 5 years was Huawei. Huawei was China's industrial jewel. It was the first global brand they managed to build. It was really standing at the pinnacle of global technology. Here was a Chinese company winning global market share, not by being cheap per se, but by being the best. And in 3 months, the US destroyed it. The US basically hobbled Huawei and crushed it. To put things in perspective, it would be, I'm French, it would be as if the US government came and crushed Airbus, and the one company that like the government is so proud of is left in ruins within a few weeks. This is what happened to China, and the Chinese government could do nothing about it. They had to sit back as the US government destroyed Huawei. And so, from that point on, if you're a member of the Politburo, you have to assume that the US government is out to get you. And in case there was any doubt, just a few weeks ago, you had Gina Raimondo, the US Commerce Secretary, come out and say that, it's US policy to slow down the rate of China's innovation growth. Now, you might think that, this might indeed be US policy, but I would think that's the bit you don't say out loud.
It's amazing that it's even quoted here. Huh?
Yeah. And it's quoted on US media, it's like, the US government comes out and openly says, look, it's our policy to slow down the rate of China's innovation, which if you're China, you think, well, hold on, what, you want me to stay a medieval country? You want me to stay a poor country? It's, so if you're China, if you're Xi Jinping and you hear this, again, put yourself in Xi Jinping's shoes, you think, okay, it's their policy to, in essence, slow my growth. How can they do this? Well, they can do it in one of 3 ways, because really I'm vulnerable on 3 things. I'm vulnerable on semiconductors because I import all these semiconductors from abroad. I'm vulnerable on energy because I import all this energy from everywhere around the world, but it's delivered to me via oceans that the US control. And I'm vulnerable because most of my trade is denominated in US dollars. And so if the US really wants to crush my economy, it can do what it did to Iran, what it did to Venezuela, and basically prevent me from trading in US dollars. And at that point, my economy just crumbles. So I think if you're China, those are the 3 vulnerabilities you have no choice but to address at this point. And all of this is basically a direct consequence to Huawei, which brings me first to the semiconductor shortage. And if to put things in perspective, China today imports more semiconductors every month than it does energy. Semiconductors is China's #1 import. So it is China's #1 vulnerability. And China's response to Huawei was basically to say, well, look, if you're going to prevent us from buying the semiconductors we need to build our own semiconductor industry, right? So imagine against this, imagine now that instead of being Xi Jinping, you're the CEO of Hynix or the CEO of Samsung Electronics or Micron or any one of the big semiconductor producers. And you're told by the US government, you can't sell to China anymore. but China represents anywhere from a quarter to a third of your sales. It's your biggest customer. Now, China also tells you from now on, I'm going to pour money into building my own fabs. I'm going to spend 60 billion a year into just developing my own semiconductor industry. Then if you're a semiconductor producer, you think, well, against this backdrop, where basically my biggest client is going to transform into a competitor, I'm not going to increase capital spending, right? Given the lack of visibility I now have, I'm going to hold back. Who's going to go out and build a new $10 billion fab? Nobody. And that brings you, 3 years later to the shortage that we're in. So the shortage that we have in semiconductors has less, I think, to do with anything related to COVID, but has everything to do with the uncertainty of what the future market looks like. Now, let's fast forward 2 years, because today China is pouring money into semiconductors. It's going to Taiwan and hiring every semiconductor engineer it can find, offering them 2-3 times the money they make in Taiwan to move to Shanghai and work on the semiconductor industry there. If so, 3 years from now, there's really 2 options. The first option is China has cracked the semiconductor code and is able to produce high-end semiconductors. And as it moves up the value chain on semiconductors, all of a sudden, the world is no longer short semiconductors. And so, or at the very least, China is not short semiconductors. So all the highly intensive semiconductor industries, i.e. the production of electric cars, occurs in China, because that's where the semiconductors are being produced. So that's option 1. Option 2, China does not crack the code on semiconductors. They pour all this money in, but somehow this money goes down a black hole and they never become an efficient semiconductor producer, in which case we still have a massive shortage of semiconductors. And because nobody's investing, because everybody's looking at China investing.
But sorry, here I'm not following you in a sense that TSMC and South Korea are also investing a lot in semiconductors, right? I think
well,
South Korea.
You see it here. You see it on this chart. They are, but let's not forget that the demand for semiconductors is going absolutely through the roof. So yes, TSMC's announced they were going to build a new fab in Arizona, but first that takes time to get out of the ground and to start producing itself. Samsung has announced that they would be doing more, etc. But on the flip side, we have goals such as moving half of our cars to electric cars. Now, an electric car consumes about 6 times as much semiconductors as a gas car, as a gasoline car. So, when you look at the potential demand, and then you have, for some reason we've decided that our fridge needs to talk to our oven, who needs to talk to our washing machine. And so if you look at the Internet of Things, that's also massively semiconductor intensive.
Yeah. So at this point in time, you're by no means afraid for overinvestment. You're much more looking at a shortage for the years to come.
Well, I definitely think we have a shortage for at least the next 18 months. And after that, it depends on whether you think China's going to crack the code or not. I actually tend to think China is going to crack the code.
Even without the ASML EUV machines?
Yeah, that's the tough bit. That's really the tough bit, but they're pouring so much money into it. But yeah, it's a gamble. It's a gamble. It's a gamble. It can go either way, but they're pouring so much money into it, hiring every semiconductor engineer out there, that I think they'll manage to crack it. So if they do, I think basically China will end up owning the electric car industry. And if they don't, then I think we're in a deep trouble.
Wow, that's a nice picture you're painting. Yeah.
Sorry, well, no. And then, but so all this to say, when you look at things like, the car prices shooting up or the appliance prices shooting up, a lot of that, of course, is linked to the shortage of semiconductors, right? Last year, for the first time ever, secondhand cars prices in the US rose more than the S&P 500. This was the first time it occurred. And this is because, of course, all the shortages that we have, at the source of this shortage is the semiconductor shortage. And at the source of the semiconductor shortage are political decisions that were taken not around COVID, but were taken 2-3 years before.
Yep.
And everything linked to deglobalization. Now, to some extent, the shortage we have in energy today is also the result not of COVID, but is the result of decisions taken 2, 3, 4 years ago. Basically, for the past few years, we've made carbon energy an uninvestable sector through ESG, through environmental regulations. The cost of capital for basically any carbon related company has just gone up a lot, to the point where every carbon company was told, look, you're better off returning capital to shareholder either through dividends or through share buybacks than drilling new oil wells and delivering growth. It was like, no, you deliver return of capital, not growth. And so here we are today with big shortages of energy. And to some extent, China contributed to that as well. And so here, let me look briefly on this front at what I think is the scariest chart today. This is the coal price in China. It's been spiking up. It's been rolling over a little bit lately. This is a bit dated, but a couple weeks dated, but was making all-time highs in spite of a very obvious economic slowdown in China, number one, and in spite of a very, very visible slowdown in Chinese real estate. So this is somewhat counterintuitive, right? Given the Chinese slowdown, given the real estate slowdown, you would have expected coal to go down, not up, and definitely not to spike up. But behind the spike is a simple reality, and that is that China shuttered too many coal mines in recent years. And for that, I think we have to blame Xi Jinping. Because again, after Huawei, what did Xi Jinping do? Xi Jinping turned around and said, by 2030, China needs to reach peak carbon. By 2050, China needs to have completely decarbonized. By 2025, we want half the cars to be sold to be electric cars. Very aggressive, very, very aggressive targets. Now, you could say, well, everybody's got aggressive targets. Macron's got aggressive targets. Boris Johnson's got aggressive targets. Biden's got aggressive targets. But, when Biden says, I want to decarbonize, the governor of California or the mayor of Denver says, well, that's nice. Good on you. And then they go on their own agenda. In China, of course, when Xi Jinping says, I want to decarbonize, what ends up happening is the mayor of Chongqing or the governor of Jiangsu, they shut down coal mines, because it's the old story. Show me the incentives and I'll tell you the outcome. Yep. For years and years, the incentives in China was creating jobs and creating GDP growth. And so if that meant adding more debt to do so, then so be it. And that's what we did. In the past few years, the incentives have changed. What you've told every local leader is, from now on, you're no longer going to be judged on your ability to deliver growth and jobs. You're going to be judged on your ability to deliver decarbonization. And so show me the incentives and I'll tell you the outcome. That's what they do. The easiest way, of course, is to shut down coal mines, which creates today's shortages and perhaps creates the more, for me, surprising perhaps development of the recent weeks. A few weeks back, about a month ago, the energy ministry came out and ordered all the SOEs to buy energy at whatever cost. They came out and they said, buy coal, buy natural gas, buy oil at whatever cost. Now, you and I are old enough to know that if you come on the market and you say, I'm a buyer at whatever cost, you don't get the best price. You usually get your eyes ripped off. And so, and sure enough, that's what's happened, right? Prices spiked. Natural gas price spiked, coal price spiked, oil price spiked. So what was China thinking? When I saw the energy ministry come out and say, we're buyers at whatever price, there's only three possible options. The first option is they're stupid, which, I don't think they're stupid. The second option is they want to wreak havoc in the energy market to, in essence, destabilize Western economies. Now, I don't think China plays that game. If it was Putin, yes, for sure. But China isn't really into destabilizing, they're all about stability first and foremost. Secondly, by spiking energy prices, they punish Europe some, they really don't punish the U.S. And China's real competitor is the U.S. China isn't really upset at Europe. Europe hasn't done anything to really upset China. The real threat is the U.S. And spiking energy prices don't really hurt the U.S. because spiking energy prices, now that the U.S. is more or less energy self-sufficient, just means that money moves from New England to Texas or from Michigan to Colorado. It really doesn't have that big. It's not that big a problem for the U.S. It's a big problem for Europe, not so much for the U.S. So the third option is the old story. If you're going to panic early. So I think China looked at its own energy situation. It looked at Europe's. It looked at India's. It looked at Brazil's and a lot of other countries and thought we're heading straight into an energy crisis. Basically, we've underinvested in energy now for too many years, and so we're heading into an energy crisis. And in an energy crisis, you just got to buy up what you can. Now, then we can debate, and I think it's that third option. I think it's the old story. If you want to panic early. China thought I got to be the first one to panic here. Now, from there, we can have the debate whether they were right to panic or not. I think they were right to panic. I think we are entering into a big time energy crisis, reflecting a massive underinvestment for the past few years, and that then leads you to the next question, which is, okay, now that energy prices are spiking up, now that we've basically really started a genuine energy bull market that will potentially see energy prices make new highs. We've already seen new highs on natural gas in Europe and on natural gas in Asia, but oil price, that will drag oil prices higher, etc. What happens next? What will Western policymakers decide to do? One option is to let prices shoot up and let the market clear. The problem there is that this has big political costs. I personally would not want to be Macron running in April with electricity bills that are up 40-50% and gasoline prices that are up 40%. It's the worst possible backdrop for an election. Especially he's going to be running against guys like Zemmour, Le Pen, or Mélenchon that will say, hey, if we stopped exporting so much of our nice nuclear energy that we've invested so much over the years for, if we stopped exporting our electricity to Germany or the Benelux, then our electricity prices would be much lower. So vote for me, and we stop exporting electricity to Germany. And then Macron will have to say, well, no, we can't because of European treaties. So then Zemmour, Le Pen will say, oh, so because of European treaties, in essence, the French consumer is subsidizing German industry.
Clear.
So this is how it works. So it's going to be a tough argument. So to avoid it, then you go to number two. You subsidize the consumer. France is already going down this path. I don't know if you saw, they just announced a Euro 100 check for anybody earning less than 2,000 euros a month to pay for energy.
Yeah, and they also put a ceiling on it, I believe, right?
Yeah. So the problem, of course, with subsidizing the consumption is you don't deal with the inherent problem of the supply-demand imbalance, right? And the path to every inflationary spiral always starts with government subsidizing energy. It's like energy prices go up, so the government subsidize it, and then that leads to bigger budget deficits, and which leads to a weaker currency and makes energy prices higher, and then you create this inflationary spiral. But that's where France is heading, possibly because nobody in our leadership has ever read a history book. The last possible option is you say, okay, we're going to ration energy. And this is clearly where China's gone. China today, if you're a steel plant, you get to work 1 week out of 2. If you're a naval shipyard, you work 1 week out of 2, petrochem, etc. But then that creates more supply chain disruptions, right? All of a sudden, you don't get the plastics you need because the petrochem plant is down, which leads to more inflation. But that's the path China's going down. But for the rest of us, it means that the hope that China's going to start cranking out deflation as it has for years and years is it's a pipe dream. China today is contributing to inflation by boosting up energy prices. It's contributing to inflation through its supply chain dislocations of the zero COVID policies, and through rationing energy use. Now, incidentally, it also means, as China rations energy use, I'll just say this as an aside, many clients are asking me, well, China's slowing down hard, real estate is busting, surely they're going to ease any moment now. Well, as long as you're in an energy crisis, there's no point to ease. It's like, what's the point of stimulating if you have to shut down the steel mills and the petrochem plants?
Yeah.
It's, if you throw money at this problem, all you're going to do is bid up asset prices. You're not going to generate any more economic activity if you, at the same time, you're shutting down the plants. And that's where China is today. So until you solve the energy crisis, there will be no massive stimulus in China. But even then, I'm doubtful on the massive energy plan. And here I'll just show you what I think are perhaps the more important charts in this presentation. The first chart is just the US equity market against the Chinese equity market. As you can tell, more or less the same collapse during COVID, then the same rebound, and then completely divergent paths in the past 9 months, right? You have Chinese equities that tank, go down 40%, and US equities that continue to roar. And this sort of opposite image, you also sort of find on the fixed income side. One of I think the discussions we had when you and I met up last was the Chinese government bond markets. Well, if you're a euro investor if you're a euro-based investor since the beginning of the year, if you bought Chinese government bonds, you're up about 10%, which is, a pretty good investment return for bonds, because if you've bought bonds anywhere else, you've lost money. Now, why is this? This is for a very simple reason, and that is that if you're China today, you have no choice but to de-dollarize your economy. You have no choice but to try to move all your trade from US dollars to renminbi. But to do this, there's not 600 ways. There's only one way people will start to accept renminbi more than US dollars, and that is if the renminbi is perceived as a structurally strong currency. And so China today is basically following a strong RMB policy, and you see this because the renminbi outperforms all currencies on a 10-year view, on a 5-year view, on a 3-year view, on a 1-year view. Pick any time frame, and the renminbi outperforms. Now, this for a very simple reason. Again, it's the only way China can de-dollarize its economy, which is now a critical geopolitical goal. And so I illustrate this because, as I mentioned already a number of times, I'm French originally, and I started my career at a French bank, Paribas, Banque de Paris et des Pays-Bas. So a bit of Holland in our name.
Yeah. We appreciate it.
And at the time in the early 90s, France had decided that it wanted to create the euro, and that therefore the French franc needed to be pegged to the Deutschmark. And everything became sacrificed on the altar of what was called the politique du franc fort, the strong franc. We needed to peg to the Deutschmark. And if that meant that the whole part of French northern industry got destroyed, then so be it. And if that meant that we ended up with 15% unemployment rate, then so be it. And if it meant that Paris real estate went down 50% and that the Crédit Lyonnais went bust and Paribas nearly went bust, then, so be it. Everything was sacrificed on the altar of the strong franc. Well, today, forget the strong franc. Today, it's the strong renminbi. And if the strong renminbi means that the Chinese economy has to slow, then so be it. If the strong renminbi means that Evergrande's got to go bust, then so be it. It's the same movie all over again. Now, in the 1990s, the best asset class to own, even better than global equities, better than US treasuries, were Italian bonds, French bonds, Spanish bonds, all those countries that all of a sudden changed their currency policy to, in essence, tie themselves to the Deutschmark. And you killed it in Italian bonds, you killed it in French bonds in the 1990s. Well, I
wrote my thesis about it at university.
Oh, really?
So yeah.
Well, there you go. So you know all about it. Well, change today. That trade has already occurred. Of course, there's no more juice to be had in Italian bonds or in or in French bonds. It might be a tiny bit of juicy because there's a bit of a spread, but it's you're picking up pennies in front of a steamroller at this point. The more interesting trade now is Chinese government bonds. A Chinese government bond market that is now, basically the new anti-fragile asset class. It is the new, the genuine portfolio diversification, because it is the only central bank that is today following a strong currency policy. It's the only central bank that is not trying to debase its currency. It's the only place in the world where you have positive real rates. So Chinese government bonds continue to outperform. The renminbi continues to outperform. Now, for me, there's no doubt that the renminbi is the new Deutschmark and that the PBOC is the new Bundesbank. An open question is whether Indonesian bonds, Indian bonds, Malaysian bonds, Filipino bonds are the new Italian and Spanish bonds, where basically their yields start to converge towards that of China. Because there was a lot of money to be made in the 1990s owning German bonds, but you made more owning Italian bonds. You made a lot more owning Italian BTPs. So today, I think there's good money to be made owning Chinese government bonds, but could there be more money owning Indonesian bonds? That's sort of our idea behind our Pan-Asian ETF government bond that we just launched, the AGOV ETF I was mentioning. So,
but Louis, I'm convinced that you have these kind of discussions with your clients as well. And I hear your story on Chinese government bonds. It's loud and clear. It's very rational. But one way or the other, there's a large group of investors who are so scared of China to say, if I buy them, they may change the rules, and then I suddenly, have something else that I thought I had. Like you mentioned in one sentence, well, if Evergrande needs to go bankrupt to keep their renminbi strong, then it has to happen. People are scared from those kind of things because they believe, everything can be dragged down on those kind of events. What would you say?
Well, I'd say if you want to look at rule changing, nobody changes rules better than the ECB. They've changed every rule since the launch of the euro. It's like, oh, this isn't convenient anymore. Let's change the rule on this and let's change the rule on that. And with that, each time they change a rule, of course, the euro goes down 4 or 5%. There is, of course, I can understand the fear inherent in investing in China. But again, I try to, when I deploy capital, I always try to remind myself of Charlie Munger saying, of show me the incentives and I'll tell you the outcome. What is the incentive of China to open up its bond market to foreigners? The incentive is to internationalize the renminbi, which they can only do if it's strong, etc. What would be the incentive of China to change the rules? Well, if they change the rules, what they do is they kill their attempt to internationalize the currency, right? And they make themselves fully dependent on the US dollar once again. So there's a very negative incentive to not change rules, right? Because if they do, all the rhetoric they've had with the Thai central bank, the Korean central bank, the Indonesian central bank, etc., they'll have lost credibility for a generation.
So this is because it's about the currency. It's a different story. They did change the rules on the Chinese tech stocks. Look at Alibaba, Tencent, dropped 40%, as you said.
Yep.
But now it's the currency, so there it's different.
Yeah, I think when you look at the government bond market and the currency, again, the view is why did they open up, and what rule did they change on the Chinese tech stocks? Fundamentally, what they did was remind everybody, and I think the market was perhaps had a wrong perception, but they reminded everybody that the Chinese government was more powerful than anybody else in China. I mean, that's basically what the crackdown on Chinese tech stock was. Now, I think we all knew that, but a lot of people chose to forget it when it came to investing in internet stocks. I think a lot of people deployed capital in internet stocks, thinking, well, it's great because this is, I can invest in China and the government isn't involved in this sector. Because it's involved in everything, right? The Chinese government is involved in energy, it's involved in the banks, it's involved in industrials. But here, all of a sudden, there's a sector where it's not involved. So this is awesome. So I'm going to deploy capital here. But believing that there's a sector in China where the government isn't involved is like believing in Santa Claus. It just doesn't exist. It's a myth. And I think what happened was people were reminded of that over the past 12 months, and with that came a big derating. But I'm not sure that any rules were changed per se. Now, when it comes to the government bond market itself, I think it's very clear why the Chinese government is opening the Chinese government bond market, and that is to transform the renminbi into a reserve currency. And really, the one rule that you could be worried about is that basically, they prevent foreigners from taking gains out and impose capital controls and whatever else. But again, if they went down this path, they would undermine everything they've worked for. So, what would be the incentive for them to do that? I know what the incentive of that for the tech crackdown was. The incentive for the tech crackdown, very simply, was again, it goes back to the Huawei decision. The U.S. was out to get them. They wanted Alibaba, Tencent, and all these guys to basically do national service. What they told those guys 3 years ago is, look, the days where you guys hire the best engineers out of Fudan and Beida and Tsinghua for them to work on ways to optimize ads on the internet and build video games, that's over. Now, if you hire those guys, the smartest guys in the room, they have to work on basically building a domestic semiconductor industry. And what happened is all those guys, the Alibaba, the Tencent, said, yeah, sure, that sounds great. And then they did nothing about it. So 2 years later, the Chinese government said, okay, enough BS. From now on, you're going to do what you're told. You're going to go out, you're going to hire the best engineers from TSMC, and you're going to, start building a hardware industry. Which brings you to last month when Alibaba comes out and says, oh, we've cracked the code and we're now able to design 5 nanometer chips.
Yep.
And so that was a big breakthrough. And then a week later, Jack Ma shows up in Europe. For the first time.
Yeah, he was here yesterday in the Netherlands.
Yeah, for the first time, all of a sudden he's let out and he's allowed to go around and give speeches again, because it's like, okay, good boy, you've done what you were asked. You've worked on the semiconductors, so now you get a European holiday as a reward.
Well, it seems he's interested in agri-tech, because he's visiting all these farmers and
doing what he's told.
Yeah.
So yeah, I can understand why the stocks derate, because if you own Alibaba, it's for the e-commerce platform or for the cloud technology, not so much for semiconductors or agri-tech. But if the Chinese got, they've all these guys have been put to national service.
Yeah.
But so I think if you look at the world that we live in, with this indeed increased presence of the Chinese government in the economy, with deglobalization, with everything, I think the first thing is, and with the unfolding energy crisis, the first obvious thing is, I think you want to avoid businesses that are highly energy intensive. Whether your utilities, your construction, some industrials, etc. Anything that's energy intensive is going to be tough. I think you want to avoid business model that depend on large numbers of low-end workers. The workforce is now shrinking in China, which is why also they can shift their political priorities away from creating jobs at whatever cost to basically now deglobalization and being self-sufficient in a lot of stuff. China used to add 15 million workers a year into the global workforce. Last year, China lost about 3, maybe 4 million workers. By 2025, they'll be losing 6 or 7 million workers, and by 2030, they'll be losing 10. So business models like Apple or Amazon's that depends on army of low-end workers, I think those business models are threatened. Now, of course, others like Google or Microsoft, they don't depend on low-end workers. They also don't depend on energy so much. So even within FANGs, there's, I think, sort of differentiations to make. I'd avoid the beneficiaries of, I definitely avoid the beneficiaries of steeper yield curves. Central banks have been, holding back, although interestingly, in the past 2 weeks, you've seen a number of central banks start to change their tune. Britain, Australia, Canada, all starting to sound more hawkish. And you've had a lot of 2-year yields shooting up. But still, I think, most central banks, well, at least the important one, ECB, BOJ, Fed, are all going to stay fairly, they're going to come late to the party, to the tightening party. So that should be good for banks, for insurance companies, etc. I think you overweight businesses that profit from the labor shortages. That's robotics. That's basically non-China emerging markets, whether you're Mexico's, your Poland's, etc. Anything linked to logistics. But for me, the big thing is that OECD government bonds no longer are anti-fragile assets. They can no longer be the bedrock of diversification of your portfolio. You have to look elsewhere. It might be precious metals, it might be pipelines, it might be infrastructure plays, or it might be Asian government bonds, since in Asia we have central banks that do seem intent on maintaining the value of their currencies.
And should Bitcoin be in this list, or do you?
Yeah, it's a tough one. So first, a mea culpa. It's really embarrassing to, be working in financial markets and have missed one of the biggest bull markets in history, because I missed it. So that's embarrassing. Having said that, why did I miss it? I miss it because when I look at my own portfolio, I'm not quite sure what role Bitcoin takes. It's not an anti-fragile asset. It's something that goes down 50 or 60% every other year. I don't think can be described as anti-fragile. It's too volatile. So if I struggle to see what role it fits in a portfolio. It adds volatility. It adds big returns. It adds volatility. For me, it's like NASDAQ on steroids. Now, NASDAQ, I can understand, and it is quite correlated to tech stocks because a lot of the people who own Bitcoins are the same guys who own NASDAQ stocks. I can understand owning a lot of the NASDAQ stuff because it generates cash flow, because there's real world applications, Microsoft or Apple, you know what they do. Bitcoin, I struggle with it because I still don't really see its application in the real world. 5 years ago, people were saying, come 2020, we'll all be paying for our Starbucks with our digital wallets and Bitcoins. But we're nowhere near that than we were 5 years ago.
Only so in El Salvador, you can pay at the Starbucks with your Bitcoins.
Yeah. I'm not planning any trips to El Salvador anytime soon.
But I think the key argument is just pure portfolio diversification. Perhaps even if you don't have any clue what the asset is going to do, it diverses. And, if any data set you run today with the short history that Bitcoin has gone, then obviously it gives a benefit to invest, like we've seen a decade ago on gold. That was also like, hold at least 5% of your portfolio in gold. But that didn't bring much.
Like you say, there's a long historical track record on gold. And, I feel gold for me, and I've written this for the past 20 years, is, gold has increasingly evolved to be a play on emerging markets, in that most of the marginal buyers of gold are now in emerging markets, whether you're, your Chinese consumer, your Indian consumer, your Middle Eastern consumer. Those are the guys who fundamentally buy gold. And so, as I look at gold, I think, okay, I can understand why it hasn't done very much in the past 10 years, because emerging markets have been, underwhelming for 10 years. And I can understand why gold did so well in the sort of 2004 to 2011 period, because back then emerging markets were thriving. So gold for me is a play on emerging markets, and so I get that. So when I want to be bullish emerging markets, I can buy gold. I don't know what Bitcoin is a play on. So that's what I mean. I struggle with it because it's I'm not, I just struggle to see the purpose it serves. I struggle to see, so.
It's clear story on inflation. There was obviously a debate last week as well. You had Jack Dorsey saying we're getting hyperinflation,
Yeah.
And then I'm sure you've seen it as well. Kathy Wood said, no, there's no inflation, and tech will solve all things.
Yeah.
Where are you? How terrible is it going to be with inflation?
So I'm good friends with Kathy Wood, actually, and I respect her greatly, and she's I think she's been a friend of my dad's for 40 years. So we go way back, and she has a tech visionary, and as much as I think she's terrific, I disagree with her on this point. I disagree with her on this point because and I think to be honest, a lot of the crux of the disagreement I would have with her probably relates to energy. And indeed, this question of, okay, today we have an energy shortage, and most economic activity is transformed energy of one way or another. So is this energy shortage, are we going to come out of it through technology? And I think Kathy would argue, yes, we will. Solar is going to keep making progress, and wind's going to keep making progress, etc. And we're going to come out of this energy crisis that is unfolding through technological breakthroughs. And I'm not poo-pooing the argument. It's it could be, but I think that's too optimistic. I think the more likely outcome of today's energy crisis is that prices continue to shoot up, and that instead of coming out of this crisis through higher technological breakthroughs, we come out of this through much higher prices, and therefore that inflation is here to stay, and that portfolios need to adjust to that.
Well, excellent. It's or excellent. It is what it is. But I like it very much that we end this presentation with clear investment recommendations that obviously everyone should consider for themselves. But we know exactly where you're standing, and I think it's very helpful. I'd like to thank you a lot for taking the time to do this with me and with us. And again, avoiding the punch. I'll show the book again, but I'll make sure it is. Yeah.
There you go.
If you want to read more, I've already read it. It's an easy, but it's a very good read to know exactly where we stand today. And if you don't know so much about, for example, China, it has these great Gave graphs in it that I always find very informative. So that's a good addition. And who knows, perhaps next year where we will be in the economy, and we can touch base again.
I'd love to.
Yeah. Thanks a lot, Louis.
Thank you very much, Jean-Paul.
Thanks.
Thank
Bye.
you.